Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. Today's Thursday. It's July 6th. Don't ask me where the year is gone. Folks, it's about 7:45 in the morning. The market's going to gear up to open in a little bit less than 2 hours, about an hour and 45 minutes. I'm here nice and early with you. Before we get too far ahead, and you know me, I get far ahead really quickly. Make sure to like our channel, subscribe to our videos, go to the YouTube Wealth Press channel. Also, you can subscribe to the Telegram channel where I post free trades, pictures of my cats, market updates, rogerscott.com/Telegram. And I've opened up my VIP room for the short period of time for everybody so you can get ahead on the second part of this video live at today is Thursday. We do it at 10 a.m. Monday through Wednesday noon, Thursday at 10 a.m. Eastern time, and Friday at 11 a.m. Eastern time. All times Eastern time. You can follow the link below this video, or if you're in the YouTube Wealth Press channel, there's a link that I post every morning below this video and in my Telegram channel. Now let's get into it. I don't want to waste any more of your time. Now, I hate to say I told you so, but boy, oh boy, did I tell you, did I predict yesterday that the chip stocks were going to pull the tech sector down? And I've got more juicy details for you on that. So far, the big issue right now is FOMC, what the Fed has been saying, and chip stocks, China, US, Yellen, all of this good stuff. We'll talk all about that. As you can see here, the Nasdaq is opening down about 66 points. That's a little bit beyond random. The Dow's down about 155 points. Also telling us that the market is not happy about what we're hearing. Now, I've been predicting a couple of things. I've been predicting that, one, the minutes from the Fed are going to be a lot more hawkish, and they were, because there's really no reason for the Fed to distort reality right now, as Powell likes to do, because the markets have been extra bullish, and they're not really interested in keeping the markets bullish and then bringing them down. It's much easier to do so when the markets are not overextended. So they're being a little more realistic with us. That's the first thing I predicted. I also predicted that momentum is going to continue narrowing into technology and will spill into the Nasdaq, and I'll go over that in a second. Here you could see the QQQ, and you could see right here that it looked like we were going to break this high, and then we came back down. Look at technology. They look almost identical, right? Well, that's because about 75% of the stocks in the QQQ are related to technology, right? That's what it is. So they're doing the same thing. If you take a closer look at Infotech momentum levels. The 20-day has already turned south. The 50-day has peaked out. Here's what's interesting. You've got a record number of stocks making a 50-day of trading above the 50-day moving average. But meanwhile, price is already cooling off, and it's already spilling into the 20-day. First, it goes 20-day, then it goes 50-day. So I'm expecting the 50-day momentum to look very similar to how the 20-day looks right now. And that means it has turned south, and I'm expecting it to cool off. Look at it over a 3-year period. We don't really stay around here very long. We don't. We come up, and then we come down. So I'm believing, and same thing over here, you could see at 5 years. We're really at some crucial levels right now. So, and the fact that we couldn't take out the highs telling us there's even less stocks now pushing us higher than right here, because you already have lower momentum levels here than right here. So it's even less stocks than normal pushing us higher. Now, this is spilling over the broader market, as you could see here, into the Nasdaq. And if the Nasdaq starts taking off to the downside, volatility will spike. What did I tell you yesterday? Since we talked about volatility spiking, it went from 13 to almost 15. It's been going up about 5-6% per day. Now, right now, we're at a very crucial level for volatility. If we break above this level, as you could see here, there's no stopping us all the way till we get to about the 18 level. And I think we are going to go down because the market's overbought. Even the Dow Jones, even non-relating to technology, you could see that we're coming down. Remember what I said about all of this? I said we're going to stay choppy. And I also said XLI was going to come back into its base, which is right here, which I still believe it's going to. I don't believe this is a new trend. I think this is just an outlier right here. And I think it's going to come down just like basic materials will. And again, basic materials are already cooling off. And if you look at momentum levels on industrial, you will see 93, 96. You remember what that means? That means we're going to come off. We're going to come off. We can't stay here very long. So in my humble opinion, and let's look at the 50-day. in my humble opinion, we're going to see some selling pressure. Look at industrial. You don't stay around these levels, and they've already curled down. So again, less stocks causing it to go higher. So I think industrial stocks, basic material stocks, and infotech is going to push this market lower. Now, yesterday we had our first post-holiday day. This was more like a Tuesday after a Monday off. Today, probably second half of the day, we'll see a little more liquidity come into the markets, definitely tomorrow. You've got ADP report today. You've got international trades. You've got jobless claims, which has been behaving itself. You've got more Fed speakers, and you got JOLTS survey, which is the employment survey. Let's talk a little bit about the economy, what we can expect, what happened, and I'll get into the technicals, and I'll show you what's strong and what's not today. So 3 major benchmark indices, the Nasdaq, the S&P, and the Dow, ended the regular session lower as minutes of the Federal Reserve's June meeting presented a hawkish outlook. I told you, while investors braced for a new round of economic data. So here's what I wanted to tell you, and this is the crux of it all. Sometimes I'm just that right. Nearly all officials supported further rate increases following a pause at the June meeting. They expressed concerns about the robustness of the labor market and the unacceptable high elevated inflation. It's sticky, and they're doing that after 10 hikes. They're saying it's unacceptably high after 10 hikes. Almost all participants noted in their economic projections that they judged an additional increase in target Fed fund rate during 2023 would be appropriate. That's it. Story's over. According to FOMC minutes released on Wednesday. In Wednesday's session, chips retreated, in addition to the hawkish news from the Fed, after China said it would curb exports of some metals widely used in semiconductors. We've been talking about that in the VIP room, and I'll talk more about that in the VIP room today at 10 a.m. Eastern Time. There's a link below or above this video on the page you're watching or in the YouTube Wealth Press channel. Google got a little bit of an upgrade, and the reason why communication services went up is because Meta, the biggest stock in the communication services, got upgraded. Otherwise, it would join the party. Meanwhile, we're now projecting a 91% probability of a 0.25 basis point rate hike. And I think we may go back to 70, 90. It's still a month away, but depends on how negative the news gets. But I'm telling you right now, we are not setting ourselves up in the stock market for upside move right now. We've got U.S. non-farm employment data. The unemployment number went from around 200 to about 270 and then cooled off. As long as it doesn't go to the 300, if it starts breaking above 300, we'll be okay. As long as it stays between 2 and 300, it'll be fine. And I think it will be fine. Now, U.S. JOLTS, job openings data, will be closely watched today. And remember, not everybody's back to work, so moves, stock and option moves could be a little bit exaggerated compared to normality, and spreads could be a little wider, but I think towards the second half of today, liquidity should come back to normal. It usually takes about a day and a half, 2 days after a holiday for things to start rocking and rolling. Initial jobless claims, this is the number that I was talking about. As long as it's 230, 240, 220, 250, even 270, as long as it's below 278, 280,000, we should be okay. Europe is down again after the Federal Reserve's last policy meeting rained concerns about tighter monetary policy, and corporate earnings are ahead, and they're not expected to be all that great, which can be a 1-2 punch. Shanghai Composite closed lower as a series of economic readings from the country over the past week, coupled with concerns regarding a potential trade war with the United States. Oh boy, don't get me started. Not good. It's going to weigh negatively on sentiment, and Secretary Yellen is scheduled to arrive in China today to foster stability. Now, has anybody ever come from U.S. to China to talk peace ever caused stability? I don't think it's ever happened. I think it always backfires. I think it's dumb for her to do this, and she's probably the worst person in the world to do that. But what do I know, right? The Nikkei also hit a 1 week low, primarily driven by chip-related stocks. Chip stocks plunged on Thursday. And remember, chips are everywhere, and chips is what caused this whole AI to come up. Airlines have been doing well. Spirit Airlines got upgraded. I'm expecting more upside for airline stocks, with energies taking it under the chin. American Express fell. Keep your eye on more downgrades from credit card merchants, because American Express does a lot of business merchants. Interest rates are going up. That's not a good combination in this economy. Vulcan Material dropped. Keep your eye on basic materials today. And we've got earnings on Levi's and Telray, the pot company. That's coming out later today. As I mentioned earlier, we've got a lot of Fed data to digest today. We may see a little bit accentuated market action pre-open and into the futures, especially first half of the day. Should stabilize by tomorrow, and then next week is a normal week. Again, I'm very concerned with technology right now because we couldn't take out the recent high. Most importantly, momentum levels are coming down. Momentum levels are coming down. This is the 50-day. This is how many stocks are above the 50-day moving average in technology right now. Where do you think we're going to go from here? It's no good. It's bad. And look at where technology is on a 1-month basis. Shoot, soon on a 3-month basis, let's see. We're at 16. See, we made so much during the 3-month period and the 6-month period. But look, this month, we're all the way down here. We're like technology's now 3 from the bottom. And soon, when you look at it cumulatively, consumer discretionary, communication, and technology will start lagging, and these will start coming up. But it needs a little more upside. That's why looking at the monthly is probably the best. And you could see communication, it's already in the middle. Technology, it's already almost at the bottom end of the range. So I'm telling you, as I'm sitting here right now, semiconductors, chip stocks. Look at semiconductors right now. Yeah, I don't think. Remember, I drew an arrow here and I said this is too much too fast, and I think we're going to be coming off. I think we're going to be coming off. Keep your eye on NVIDIA. Keep your eye on the big ones, because once NVIDIA dumps, once it dumps and comes here, it's going to fill this gap, and I think that's going to happen during earnings season. We may get some flight to quality from the bond market. I think it's going to bottom out here and start coming up because everything with the bond market is priced in right now. There's really no uncertainty, and we've been going through this 110, 100 channel now since December of last year. So again, I think we're going to continue doing that for the time being. My concern right now, my biggest concern right now, is the reaction of the stock market and whether chips are going to pull technology and other related sectors, and we're going to see an undoing of what we saw the last couple of months in technology. And I'm afraid that's the most likely scenario. I just don't see a catalyst for driving technology higher right now. Now, folks, brace yourself. I've been working with a private group of 92 beta testers perfecting a special type of software. It's a software that's so powerful, it's able to track exactly what big Wall Street money is likely to flood into a stock at any time. And the track record on this new system on live trades, well, it speaks for itself. In fact, we just locked in a 28.89% gain yesterday on UAL. We've nailed 24 out of 28 trades. Our win rate is 86% right now. Average return on all the winners and losers of 16%. So we're making 16% net on average every 5 days. That's crazy. I'm so convinced this new software will change the game for retail traders worldwide. I just filed a patent for it. That's right. So, if getting in front of what could be some of the biggest moves on Wall Street is something you're interested in, click the link below and get all the details for free, no cost. You don't want to miss out. And we're going to have a Q&A session in my VIP room. After my VIP room today at 11 o'clock, I'll fill you in on everything. Make sure, like this video, subscribe to our channel, post comments, subscribe to rogerscott.com/telegram, and join our VIP room. I'll know if you're not there. And if you still have any questions, send me an email, support@marketgeeks.com. Remember, if getting in front of big moves is something you're interested in, follow the link below, no cost. It's been the hottest thing ever. You guys are going to love it. And have a great Friday Eve. Bye.